Hello learners, today we are gonna do the fixed and tangible asset topic. In fixed and tangible asset, where is the topic which we covered in grade 11 and also grade 12, and also the basics are from grade 10, So now on the fixed and tangible asset, we're gonna start by the introduction. After, please check my other videos where you'll get the questions, where we'll be solving the questions, but the main focus will be about depreciation. If you are unable to calculate depreciation, please check the other videos. So first thing, what is a tangible asset? A tangible asset is an asset which is physically substance you can touch and can see. Examples are just like equipment. In equipment we include machinery, computers and furniture, and vehicles we include trucks and bikes, and land and building. So we have some GAP principles, 3 GAP principles which will be applied in this topic, fixed and tangible asset. The first GAP principle is the historical cost. We said we consider the original cost of the purchased asset, which states that all tangible assets must be valued at their original cost price, which they were purchased for. It means all our assets will be recognized using the cost price and also derecognized using the cost price. When we dispose the asset, you're gonna take out the cost price. Okay, so the other one is our matching principle. Matching principle, we match the depreciation to the date of disposal. It means we're gonna calculate the same depreciation using the same method without changing from the date of purchase to date of sales. And the other method is called prudence. Prudence is all about selling, That's why the GAP principle prudence applies when we dispose the asset at a reasonable price. Okay, so the other important part, you must always know that on this topic we have some dates. Dates are very important in this topic. So you must always know that the beginning of the financial year of the company and also the end of the financial year of the company, and the date at which the new asset was purchased and the date when the asset will be sold. So these are important things to highlight on the transaction. Please make sure you highlight your date very well and know the date, especially the beginning of the financial years. The following, we have the following part. So the following part is about timeline. Please make sure you draw your timeline very well in order for you to calculate the period which the asset is spent inside the year. So please make sure after identifying your dates, please make sure you draw the timeline and allocate your dates. So timeline is very important. You will use it perpetually or continuously when calculating the depreciation of an asset. It is a line which shows the beginning and the end of the financial year. So I'm going to show you how to draw a timeline. So how to draw a timeline? When you'll be drawing a timeline, you must first identify the dates. So you're going to just draw a simple line, and on the first thing you'll say the beginning of the year, beginning of the financial year. Okay, after here you're gonna say at the end of the financial year. After it means if your year has commenced on 1 January 2020, it means the end of the financial year will be 31 December, my favorite time, 2020. It means every transaction which will occur within this period, it means you have to recognize or record that transaction. So you must, after identifying the beginning of the financial year and also the end of the financial year, you must again record the dates, the other dates which you have identified on the transaction. Just like the date when you purchased an asset, it means the new date was if example, you'll be given a date when they said they purchased this asset for this amount on this day. And also the other one, the date will be the sold asset. So please make sure you must identify these two dates. After then, you'll be able to count the dates, because when you'll be counting the dates, the period which the asset has been inside the asset. Can I explain this further? Okay, we're saying how to use the timeline on the following transactions. On a new purchased fixed and tangible or tangible asset, the new asset which you purchased, you will count the month from the date that tangible asset was ready for use, or when it was purchased, until the end of the financial year. It means from the date it was purchased until the end of the year. You'll be able to find the month in which the asset is spent inside the business. Remember, the timeline is a very important tool to calculate depreciation. So it means when you come here, it means after identifying the date which the asset was purchased, just like, for example, let's just you purchased the asset on 1 July 2020, for example. It means you'll count the period or the month which the asset have spent inside the business during the current financial year, from 1 July until the end of the year, 31 December. It means it will be, and please use your hands to calculate, use your fingers to calculate. It means you're gonna say July, August, September, October, November, and also December. It means it's 6 months. You have to say it's 6 months. After calculating, you will know that the period which the asset is depreciated or has been spent inside the business is 6 months. So for an asset which was sold, as we continue, a sold tangible asset, it means a sold tangible asset is an asset which it was used by the business from the date it was bought or ready for use. And after we calculate the depreciation of the asset from the date it was ready for use or was purchased and used by the business until the date it was sold. It means we are speaking about the date from the date of purchase to date of sales. It means now, and even during the current year, during the current financial year, which will be disposing the asset, it means you're gonna calculate the depreciation of the asset for the period or the month which it has spent inside the business. So let's show you. So it means on our example, it means we had the beginning of the financial year and also the end of the financial year. It means if, for example, they've sold the asset on 1 August 2020. Let's say they sold the asset on 1 August 2020. It means you have to calculate the month of the how many months did the asset spend before it was disposed. It means you're gonna count from the beginning of the year until 1 August 2020, the date it was disposed. As I give you an example, so it means you're gonna calculate please use your hand. You're gonna say January, February, March, April, May, June, July, August. It means it's 8 months. It means you're gonna say 8. But the problem, no, it won't be 8 because of it was disposed on 1 August. It means you're gonna calculate until September. It will be 7 months because it was disposed at the beginning of the year. It means gonna say 7 months. It means now when you are gonna calculate depreciation, you'll be calculating depreciation for the current period. For the sold one, you're gonna use 7 months, and also the new one is gonna be 6 months. And also we have the asset which has spent for the whole year. It means 12 years. It means the old asset. It means the all assets. So let's continue by explaining what is a depreciation. Okay. Second part, we're gonna talk about depreciation. Many learners are saying they are unable to calculate the depreciation. So let's start. What is a depreciation? Depreciation is a systematic allocation where you'll be allocating the depreciated amount of the asset over its estimated useful life. Depreciation is part of the total cost of the asset that is inputted to a specific accounting period. It means depreciation, for example, is just like a tree, where a tree, it has some leaves, but the minute the tree it is when the leaves are falling down, for example, it means that we can say is a depreciation, because at the end that tree will have only the branches, or you purchase a new laptop like this. After then, when time goes on, that laptop is not the same as it was purchased during the date it was purchased, not that brand new. That's a depreciation. So we have three methods. We have three methods of calculating depreciation. Just we have not listed the other one here. So the first method, we have straight line method, diminishing balance method, and also the carrying value minus one method. We call it the carrying value minus one method. So we have not added that carrying value minus one method here. After that method, I'm gonna show you. I'm gonna explain the first one. The first part is straight line method. Straight line method is also called as cost price method, a cost method, or fixed installment method. And this cost price method is this depreciation. We calculate depreciation based on the cost of the asset, and it means we write off the fixed amount of the asset over its expected useful life. So another example about, let's say I'm going to give you the example on a straight line method. The first thing we say, for example, ABC Enterprise bought a new vehicle or a new machinery, on 1 January 2016 at the cost price of 20,000. Depreciation is calculated at 10% on cost method. It means I'm just giving you this example on cost method on 31 December 2016 at the end of the financial period. It means now, first thing, we just take the cost of the machinery, which is 20,000, and multiply it by the depreciation rate and use full life, which is the period it has spent inside the business. Okay, from there we have how many months. It means this asset has spent 12 months inside the business. It means from depreciation from 1 January until 31 December. It means 12 months. You're gonna say 20,000, which is the cost, multiplied by 10%, multiplied by 12 over 12. That's how we're gonna calculate the depreciation. But let's get here. Depreciation using the diminishing balance method. The second method. Diminishing balance method is also called a carrying value method or book value method. So we calculate depreciation on the carrying value of the asset, and the carrying value or carrying amount is calculated by subtracting the cost price by the accumulated depreciation. It means carrying value is cost price minus accumulated depreciation of the asset. We calculate a given percentage of the diminishing balance method of the asset. Diminishing balance method is the same as carrying value or carrying amount. Okay, example, ABC Enterprise has only one vehicle at the cost of 45,000 and accumulated depreciation of 15,000 at the beginning of the year 1 January 2016. Depreciation is calculated at 20% on diminishing balance method and on 31 December 2016 at the end of the year. So you're going to just say the first thing, we first calculate the carrying amount of the asset by saying carrying value is equals to, that's the formula, carrying value is equals to cost plus minus accumulated depreciation. Our cost is 45,000 and accumulated depreciation is 15,000. It means our carrying value is 30,000. It means after then you're gonna say what? after calculating the carrying value or carrying amount, we calculate the depreciation amount by application of the timeline. Please use the timeline. You will have the beginning of the year, which is, and this asset has spent 12 months inside the business, and the end of the year, which is 31 December 2016. Okay, so from there you're gonna say the cost or the carrying value. So the carrying value is 30,000 multiplied by 20%, the depreciation rate multiplied by 12 over 12, because the asset has spent 12 months inside the business. It means depreciation will be 6,000. So depreciation for the year will be 6,000, but accumulated depreciation on the asset on the 1 December is accumulated depreciation at the beginning of the year, which was 15,000. On our question, it was 15,000. Our accumulated depreciation. Where's our question? Sorry, our question is 15,000. Oops, I'm getting lost. Our accumulated depreciation at the beginning of the year was 15,000, and also at the sorry. Oh, okay, I'm back. Accumulated depreciation on our question at the beginning of the year was given as 15,000, and so you're gonna calculate your depreciation using. It means accumulated depreciation at the beginning of the year was 15,000, and depreciation calculated during the year was 6,000. It means our accumulated depreciation at the end of the year was 21,000. Thank you for watching this video. Please subscribe and you'll get more videos on this and other examples. Follow my YouTube channel. Please support. Please subscribe. Just subscribe to this YouTube channel. Please subscribe, and hit the notification button. Please subscribe.